Welcome friends to this NPTEL module on international trade theory and empirics. This is a read on course, and we already plotted this in the last year schedule. This year again it is being floated due to demand among the participants or among the generation among the students or the participants. Now we are at the 11th week of the module, and we are understanding the dynamics or the adjustment in terms of current account balance through fixed exchange rate and flexible exchange rate regime, and how price and quantity gets adjusted, and in the process how it gets passed through, okay, how it passes to other directions. In this context, there are lots of debates, discussion made in literature, and many countries and their impact through inflationary changes, through exchange rate adjustment are made. I think number of times Professor Geeta Gopinathan, of the chief economist of IMF, used to contribute in this direction. So, coming to the discussion, how the exchange rate pass through is discussed. Now, first point to be noted is that the exchange rate pass through, in short it is said ERPT. Okay, ERPT is the responsiveness of trade prices, all right, and that is expressed in local currency to the unit change in exchange rate. So, the coefficient measures the degree of responses. Once again we are emphasizing the responsiveness of it, and the degree of responsiveness is important. ERPT is complete if there is a proportional change in the prices on account of a unit change in the exchange rate, and is incomplete if change in the price is less than the proportional change in the exchange rate. So, it is basically the delta change in prices, price index with respect to percentage change in exchange rate. Okay. Now, if these two are equal, then it will be 1, all right. Now, that is what is called complete, all right. ERPT is called complete, with the change in 1 unit of exchange rate leads to proportional or the same percentage change in the prices. Okay. The price, how it is reflected, we are now discussing in detail. The responsiveness of prices of internationally traded goods and services to exchange rate movements has of late assumed importance in open economy macroeconomic analysis of developing countries. So, this is part of the open economy macroeconomic discussion of the developing countries, because the developing countries and their trade volumes are quite dynamic, and they are progressing, it is not in a very balanced manner, they are huge ups and downs. So, the open economy macroeconomic adjustment in developing countries is different than that of the developed countries. By the turn of the century, two influential forces, that is the Taylor hypothesis in 2000 only, and a new economy macroeconomic, that is NOEM, new economy macroeconomic models proposed by Opsfeld and Rozov in 2000. Both the theory were lifting the concept of exchange rate pass through to domestic prices out of its microeconomic origins and mainstreaming it into the formulation of monetary policy. Now, important aspect to be mentioned, one is Taylor hypothesis, one is NOEM, that is open economy macroeconomics. Okay. Okay. So, new open economy macroeconomics by Opsfield and Rojov, they lifted the concept of exchange rate pass through. All right. They discuss about its connection with domestic prices out of its microeconomic origin. It is not just the microeconomic demand and supply within the country, or even demand and supply externally is responsible for the adjustment in the market for goods and services. Rather, it is due to the exchange rate implications. So, they have mainstreamed the formulation of monetary policy accordingly. So, these two theory are important in this context, Taylor hypothesis and NOEM models. Theoretically, devaluation of the home currency leads to an increase in the import prices in terms of home currency. Following the home country currency's depreciation, the price of imports in home country and its currency rises, which in turn reduces the domestic demand for imports and results in lowering of exports share market share. Okay. So, in order to maintain the existing market shares, especially in the short run, exporters generally adjust their markups. Okay. So, in this to maintain the existing market share of the depreciation and its implications on home country transactions. So, in the short run, exporters generally adjust their markups, but in long run it gets diluted. The higher the price elasticity of demand of a country, lower will be the markup over the production cost. Okay, that is important aspect. Higher the elasticity of demand, if the elasticity of demand for a product is higher, so with the rise in prices might distort the demand pattern and the implication might be problematic. So, therefore, if the higher is the price elasticity of demand of a country, lower will be the markup over production cost. All right. So, lower and higher I am just pointing out, you can have a check. Okay. Now, this also explains why exchange rate movements often do not bring about proportional change in import prices and pass through is actually incomplete. So, proportional change I have already mentioned and why it is called incomplete. If it is not reflecting on the exact unit of change in terms of prices, that is basically called incomplete pass through. Okay. So, market segmentation is one of the possible reasons for incomplete pass through. Market segmentation to be emphasized. The division in the market based on the elasticity of demand is one of the reasons. If it is perfectly unitary, then there could have been a correct implications in terms of reflection in the prices. So, due to the market segmentation, it allows imperfectly competitive firms. Okay. So, market setup could be imperfectly competitive to charge different prices for the same product in different export market. Okay. So, the markup pricing are actually differently set for different export products, is not market governed at all. Therefore, the pricing to market, that is PTM, depends on the market power. Okay. So, we are mentioning market power of the respective firm in the export market to a large extent. Then again it has connection with small country versus large country debates, we have discussed largely in our earlier discussion. So, market power, pricing to market or market power is important, market segmentation is important, competitive market structure is important, then that leads to incomplete exchange rate pass through. So, why incomplete? I am just writing incomplete exchange rate pass through ERPT. All right. Now, for instance, as mentioned by Halpern and Koren in 2007 find import prices are higher for products of firms with greater market power. Okay. Having greater market power, import prices are actually higher, because they can monopolize their market and take the markup pricing to their profit. Okay. And however, in the long run, permanent change in nominal exchange rate may lead to complete adjustment in import prices, with pass through being complete in the long run. Okay. So, long run permanent change may complete the exchange rate pass through. So, there are two directions roughly we wanted to say. One is called short run and another is long run. Long run implications. Long run, usually the market price is less, because market eventually adjust to the variables, and these all depends upon factors like market segmentation, generally by elastic demand varies from market to another market. Then imperfectly competitive market, imperfectly competitive market. Then third point wanted to emphasize is the market power. Fourth one, we are emphasizing on firm share, firm's share. If it is a dominating firm, then firm may take advantage accordingly. Then we can discuss about usually in the long run it is complete, but still it is not 100% guaranteed. Okay. So, these are complete clarifications so far. Now, we are giving some citation and examples to it, emphasizing India's trade performance and exchange rate movements. So, trade reforms, though a piecemeal way, were initiated during the early during the 1980s, whereas exchange rate reforms towards a market determined exchange rate of the rupee started in the early 90s. Okay. Though trade reforms initiated during 1980s, but the market determined exchange rate were began in the early 90s. So, these two periods to be emphasized, trade reforms and market determined exchange rate. So, this is however not to say that there were no exchange rate reforms prior to 90s. It is wrong to mention that before 90s there were no such trade reforms. The major trade policy changes in the post 1991 period included removal of quantitative restrictions. So, why it is called the major post 1991 period is called major trade policy reforms? Because of removal of quantitative restrictions, replacement of such restrictions by tariff, quantitative substantial reduction in the tariff rates. Also, there are dispersion and simplifications of the procedure related to trade flows. Okay. So, dispersion and simplifications of trade procedures. With the foundation of WTO in 1995 acted as a catalyst to this process of trade liberalization, and where India since India being the member founding member of WTO follows the norms of the trade liberalization proposed by WTO since 1995. The trade reforms in India, trade policy reforms in India on the whole aimed to reduce the distortions in terms of relative prices, removing anti export bias, improving competition, thereby enhancing international competitiveness. Okay. So, it connects to international competitiveness, export bias, then relative prices, okay, etc. So, largely it discusses trade liberalization. Why we are discussing these things? Because how India is projected in the process of exchange rate pass through. Okay, since exchange rate has been market determined since 90s. Okay. Now, exchange rate and policy changes and their movements, how it has occurred in the Indian context. In 1991, following India's balance of payment crisis, which erupted in the early 90s, a series of currency reforms were taken. Those measures are undertaken in addition to the other structural reforms. Other sectoral and structural reforms measures were taken during the 90s, but the currency reforms were also discussed largely to correct the balance of payment crisis. All right. So, one of the reasons of connecting to the exchange rate pass through is also to discuss the balance of payment crisis. All right. A transition to a market determined exchange rate regime was felt necessary to deal effectively with different sectors in initial reform measures. Okay. So, the market determined exchange rate was effectively connecting to the different sectors in the initial measures as well. The Reserve Bank of India undertook a sharp downward adjustment of exchange rate of about 18% in two stages from July 1 and July 3 of 1991. Okay. So, 18% adjustment downward was made to deal with the crisis in the balance of payment. This set the stage for more fundamental changes in the exchange rate regime as well as recommended by the high level committee on balance of payment. By set up this high level committee was set up by the Government of India. Okay. This adjustment was followed by the introduction of the liberalized exchange rate management system. In short, it is called LERMS, LERMS, liberalized exchange rate management system. Liberalized exchange rate management system introduced in March 1992 for the adoption of dual exchange rate system in India. That is another important aspect to be mentioned. So, the introduction of the LERMS LERMS from March 1992 discuss about the dual exchange rate system. Okay, that is important to note for objective questions as well as for any other competitive exam. So, this time period to be also when did India introduce dual exchange rate system, and which committee has proposed and under which system it is called LERMS. Okay. This dual exchange rate system implied a depreciation of about 11%. 11% for transaction routed through market. If any transaction was made and routed through the market based, then there will be a depreciation of 11%. However, the dual exchange rate imposed an implicit tax on export proceeds due to the depreciation attempt taken by the government, and if it is rotated through market, then there will be a implicit tax on exports. Okay, implicit tax on exports proceeds or remittances which hindered supplies of foreign exchange in the foreign exchange market. Okay. This is also connected to the dual exchange rate system. All right. Now, consequently, downward pressure had been building up and the regime was also overdue. Okay. So, these has led to a downward movement in the exchange rate. Subsequently, in March 1993, the dual exchange rate system gave way to a unified exchange rate system. From March 1993 onwards, India followed a unified exchange rate system, which along with removal of exchange rate restrictions on imports through the abolition of foreign exchange, budgeting are the initial steps towards current account convertibility. Okay. So, there were discussion also on current account convertibility, this is also in short called CAR. All right. To introduce the unified exchange rate system, and also to discussions were made to have current account convertibility. The final step towards current account convertibility was taken, this is very important to note, was in August 1994. The CA were finally undertaken or was actually considered current account convertibility, like any kind of transactions in the current account that gets convertible to the international currency very quickly. So, Indian rupees need not be exchanged or could be exchanged to any currencies since India has opened up its current account transactions. Okay. From August 1994, current account convertibility was introduced, and that has further liberalized the invisible transactions also, and exchange rate controls regulation into a specified limit. Okay. Since then, the exchange value of the Indian rupee was determined through demand for and supply of foreign exchange in the market and is not administered. Especially exchange rate value of Indian rupee was determined through the market, not by the administered rates. So, in the current account, demand for and foreign exchange, demand for and supply of foreign exchange, especially for the current account transactions, were completely market based, okay, especially from August 1994. However, the RBI continued to intervene actively for the trading in the foreign exchange market with the aim of containing the volatility and thus influencing the currency value. So, RBI has been intervening in between to check the volatility and also the influence the currency value. All right. Then so, there are a couple of points we have taken down, and that is very important. So, dual exchange rate, then unified exchange rate system, then current account convertibility. Okay. From here we discuss about LERM. Okay. So, I will mention one by one. Okay. All right. So, LERM for your better understanding, LERMS. Then we discuss about dual exchange rate, system. Okay. On March 1992. Okay. Then basically some important points on the implicit taxes on exports, implicit taxes on exports, export proceeds, not export, exports proceeds. Then that leads to in an unified exchange rate, exchange rate system in March 1993. Then a discussion were made for CR, current account convertibility, current account CSC, current account convertibility in August 1994. Okay. Then basically you may take a note of okay. So, market based, complete market based approach in current account. Okay. Then another important is RBI's intervention to check the volatility. Interventions to check volatility. Okay. So, these are important short points you must take a note for better understanding. Now, the rupee again exhibited a reasonable stability up to mid 1997, when the Indian rupee experienced a mild track of contagion emanating from the East Asian crisis. So, there were contagion effect because of the East Asian currency crisis, especially noted in 1997. So, rupee exhibited a reasonable stability till 1997. So, there are some mild attack to the rupee instability, especially due to the East Asian currency crisis. During 1998, exchange rate managed to exchange rate management of RBI continued its focus on smoothing excessive volatility in the exchange rate and maintaining orderly market conditions. The rupee has marginally appreciated against the dollar after 2002-3. So, this is very important. There are rupee appreciation against dollar in after 2002 and 3. Now, these are some of the trends of India's how exchange rate against dollar, India's exchange rate against dollar. So, here we are mentioning rupee dollar exchange rate. So, as per the annual exchange rate, given the data, with the depreciation in the currency value after mid 1980s, the table indicates that nominal and effective exchange rate depreciated from mid 80s to early 1990s. Okay. So, 80s to mid 80s to early 1990s, there was appreciation of the currency. The rate of depreciation was very high during the early 90s due to the devaluation of currency. All right. Now, some other annual percentage change in India's nominal effective exchange rate and real effective exchange rate, that those we have already discussed. It is basically basket of currencies considered, their nominal value and real value has been considered, and the results are taken from the Reserve Bank handbook of statistics on Indian economy of various years. You can also update. This is I am just explaining for clarifying the theory. The latest figures are not here. You can connect to the RBI website of the same source. Okay. However, the nominal effective exchange rate appreciated during the 1993-94 and thereafter again 97-98. Okay. Between 2001 and 2002-3, the nominal exchange rate appreciated in most of the years. The large devaluation of the Indian rupee during 1991 is also reflected in the behavior of real effective exchange rate. Okay. So, you can take a note of these changes. On the average, this is negative, near is negative of this entire period from 1985 till 2006, and in both the indicators average is in negative. Now, so but the effect is lower in rear as against near. All right. The movements in India's import prices. In general, the 1990s decade is described as the era of price stability all over the world. So, the opening of Indian economy during the 90s, along with higher order of depreciation, increased uncertainties on account of fluctuations in the global economy and added to pressures to the prices to rise. Especially during this period, import prices of most of the products groups show upward tendencies. Okay. The unit value index for especially for beverages and tobacco, I think I will show that in the example, was the highest among all the non oil imports. Okay. For all other oil imports, unit value index shows an upward trend, though within a narrow band. Okay, I think these are the details we will again explain, or you may also follow from the same source, okay, which we have quoted from the beginning, and you guys can able to understand. So, to take a note that unit value of beverages and tobacco was the highest among all the non-imported commodities. For all other non oil imports, unit value index shows an upward trend through within a narrow band. What is important to note is that exchange rate pass through occurs, but it affects differently. There are possibility of volatility, how India has gone through in opening up his exchange rate, and how in current account is reflected, how how it gets adjusted through different phases. Okay. Like we have already said, dual exchange rate system, unified exchange rate system, but the capital account convertibility has not yet been approved by Indian government. Till the date it has not been approved. All right. So, these are all the details in insert, and you can follow some other articles like implications of exchange rate pass through ERPT on developing economies, on BRICS economy. I have all those additional document I can share if you want. So, on BRICS countries, BRICS, then developing countries in detail, being countries. Okay. Some article from the journals could be also referred. Because of paucity of time, I am not referring all the latest updates. So, you could have also search on your own to understand it better. With this, I think I should stop here, and I will carry forward the optimum currency area and its implications due to the exchange rate movement in the next class. Thank you.